Hey, good afternoon. Welcome to our 3-Minute Thursday for October 27th. And we got a lot of things to talk about here. Let's dive right in today. So first of all, I wanted to touch on a little bit of the performance for the last month. There wasn't too much the last couple of weeks, but we're currently looking for longs, and we're expecting more hawkish from the Fed on November 2nd. We've talked about that for a while. There may be more dovish talk, however, at the press conference as pressure is increasing from the Fed to pivot. We don't think that's going to be the case. Performance here lately has been really, really good. The S&P is up 4.7% month to date. That's actually the last week, to be honest with you. The big winner is the Dow, which is up 8.2%. The big loser is emerging markets at negative 1.2%. So the U.S. has been on a pretty good run, and we see that to hold true for the next couple of weeks to a couple of months ending into the last part of the year. So the sector performance is month to date is actually energy, and I cannot believe this, but energy is up 57.9% year to date. Technology is up 4.7%. However, that's going to be given back mostly because most of the tech companies did miss earnings over the last couple of days. We'll dive into that here in a few minutes. Materials are up 6.4%. The biggest loser here, it continues to be real estate and utilities. Month to date, utilities is negative 3.3% and REITs are at negative 3.8%. They've been the big loser holistically, has been real estate year to date as well. The dollar continues to be at its highest or strongest amount at 112. We think we're probably at a top of the dollar, but we'll keep watching currencies as we continue for the end of the year. Last is real GDP. So we're looking at third quarter GDP has been revised a little bit here, but it's still looking at, I really want everybody to pay attention to Q1 of 2023. We're showing a 0 GDP growth and then marginal going into the end of the year. I wouldn't be surprised if that 0 GDP growth actually continues for the first half of the year for the first two consecutive quarters. Also, rate hikes. Remember, November 2nd is going to be one of the biggest times of the year as we see Fed Chairman Powell is expected to raise interest rates 75 basis points or 0.75% on November 2nd. We think that's going to be the last big rate hike. We might see a very small one in December, and then we should be pretty clear going into the rest of the year. So that's probably going to give us that pivot that we need, is to get over the rate hikes in November 2nd and then have midterm elections on November 8th. And we might see a really good rally going into the end of the year. That's our expectations. We're pretty excited here. So the overview for the week is we're looking for longs in this environment. The 10-year yield and the 3-year yield inverted. So we talked about that last 3-Minute Thursday as well. That's always been a telltale sign of a recession. We're already in a recession. We think that's going to continue into next year, but I think we're at the bottom of the recession here. The Fed, big meeting, November 2nd, just got through saying that, and then we'll talk about China here in a little bit. So I wanted to point this out. This is the S&P in the Bloomberg U.S. aggregate total return, so the bond market, right? So the S&P is down still negative 20%, but why this slide is important is look at what the U.S. aggregate bond market is. It's actually down negative 17%. So going all the way back to the 1990s, this is the worst performance that we've seen in both the bond market and the equity stock market. So this is one of the weirdest, unique times I've ever been in my professional career. We think there's a lot of opportunity going forward, but it has been a very challenging market for this year. And I think everybody feels that as they look at their statement. So we're cognitive of it. We understand that no losses are ever good, but we think we're at a tipping point here where we could see the markets go higher, especially in the last quarter of this year. So we'll keep watching that. We also think the bond market's probably at its close to bottoming here, and there's good opportunities for us in the bond market moving forward. We'll talk about that at a later time as well. So let's dive into the rally is actually here. And so it started just about a week ago, and you can see the line where we kind of predicted back on the 10th that we're going to kind of get a bottom. It dipped down and it's starting to carry up. So right now we just broke 3790 in the S&P or the overall market. We expect this to run all the way up to 4100 region. I would not be surprised if we top out at 39.50, but that's kind of the range we're looking at. And then we're going to start taking profits and starting to move the portfolio in a lot of different directions, including the bond market. I actually think there's some really good long-term gains in the bond market going forward. So 10-year and the 3-month Treasury yield did invert. It's slightly inverted, negative 0.03 of 1%. So it's there. Little concerned about this, but this has already happened a couple of times inside of inverted yield curves. Again, like 80-90% of the time recessions come from inversion of yield curves. What this means is the markets, right, that the Fed actually sets what the yield is going to be or what the interest rates are going to be every single month when they come out and raise rates or lower rates. But what a lot of consumers don't understand is everything past them setting that rate. So the 3-month, the 10-year, the 20-year, the 30-year, all of these are actually set by the market. And so when the market inverts like this, what it's saying is that the rates are getting so high, so fast, that the consumer that's buying the products, right, these institutional investors do not see value anymore from holding a 30-year bond or a long-term bond. They truly see value in holding something that's very short duration. So that means the short duration yields will actually be higher than the long duration yields. And that's when the whole markets get out of whack. And that's when you can see a recession going forward. So we've been really holding these short duration yields and we're starting to get benefits from that. But we're going to start moving into the longer duration yields as we see a top in what the Fed's going to do, and they're no longer going to raise rates. The Fed meeting coming up is November 2nd, and there's expectations target between 3.5 to 3.75. It is not likely to pivot in November. So we are thinking, because the market is starting to waffle a little bit here, that the Fed will actually reduce the 0.75% or 0.75% rate hike. I don't think that's going to happen. I think the Fed Chair President Powell is pretty much had his mind made up that he's going to raise 0.75%. All right, the China collapse. This happened early this week. This caught everybody by surprise. There's no economic data to actually justify this, other than the fact that the president of China here decided to remove some executive people from the government and pretty much put in his own political party inside of there, which scared the market pretty bad. Market inside of China was down 20% in one day. I think that was Monday here, but it's since recovered already. So it's been up between 9 and 10% just when the last day or so. So I think this is going to be short-lived because it's more of a political event than it is an economic event right now. Now, if he starts changing what's going on economically, and especially publicly traded companies in China, then we're taking point of this. We're actually divesting a lot of our international equities, but there is a few of them we're actually buying into this weakness because we don't think it's going to be long-lived. And there's such great companies that are undervalued. So we're paying attention to this and we're looking to be long-term investors here. Let's talk about our key points and takeaways. So 1, we're looking for longs here, trying to find some great winners. We're looking at energy to be more optimistic. We are going to avoid the risky bets. We're waiting for price levels before any large decisions are made, but we're going to look for some beat up securities, especially in tech. We're focused on the U.S. markets right here. As soon as the Fed meeting on November 2nd, that's going to be a very pivoted meeting. Overall, we're still looking at the markets for opportunities. Sectors like energy and materials appear to have some potential here. We're slowly finding areas of value. With the last push down, we're finding the risk reward to be somewhat favorable moving forward. But we are aware of the economic risk that has presented itself during these last couple of days, especially as some of the biggest tech names have missed. Well, that's it. That's what we have for our 3-Minute Thursday. Here's a little bit of our disclosures. And guys, we're in the middle of our sprint for client reviews. So in the next couple of weeks, please feel free to reach out to me and let's have a great conversation. We'll talk to you soon.